We have a new law which is going to tax the rich. The Australian government has brought in the unrealised capital gains tax, and it's potentially going to also happen in the United States. So in this video, we're going to explain what unrealised capital gains tax is and how you might actually want to rejig your investments if you're wanting to minimize or avoid this tax altogether. Now, my name's Luke and I talk all things real estate, renovating and financial freedom. If you get any value out of my videos, I love producing this free content. So if you could subscribe down below and drop a like on this video, it would be much appreciated. Now, this new tax gives incentive to move money out of superannuation. The new super tax is a heavy surcharge on long-term investments because most of the gains from growth assets come from the value of gains which are mainly due to inflation. At the end of February 2023, the Australian government announced plans to introduce the new tax on superannuation account balances above $3 million. So look, if you haven't got $3 million in your superannuation account, you can breathe a sigh of relief because this unrealised capital gains tax is only going to affect the wealthy who have $3 million plus in their superannuation. Think big business owners, think high net worth individuals like doctors and lawyers, and think of farmers even as well who might use their superannuation to own and control their farm. This new tax captures unrealised gains from any rises in the value of shares or property or other assets every year, even if they are not sold. That's just mind-blowing to me. They're going to tax people on unsold assets, on things that haven't been transacted and might be illiquid. You might have shares that no one else wants to buy, even though they might have a high balance sheet value. Or it might be difficult to make those sales. Property does take time to sell. Or how are you going to sell part of your farm? 1% of your farm, you have to subdivide. How are you going to sell that off? Maybe you need to sell shares in it. So it's going to be very difficult for people with illiquid assets to actually pay these taxes. It's an extraordinary departure from the existing tax system in Australia. People with super balances above the threshold will be better off holding the same asset outside super, paying tax at the top personal marginal tax rate of 47% than leaving them in super paying the new tax. So what this means is the Australian government is heavily encouraging people to limit their superannuation balances to $3 million. I'm going to be perfectly honest with you guys, and I actually don't think this is wrong. I don't think this is a big or a bad issue. I think that people have been abusing the superannuation system for far too long. People with $100 million, $200 million, $500 million have been able to use the superannuation environment to hold and control these assets in a very, very tax effective environment. Why was super created in the first place? Why do we have superannuation? The purpose of superannuation was to make payments into an account separate from your main wages to build up money for retirement. And I can say for myself, and hopefully most of you guys can say, that $3 million is plenty of money for people retiring around the age of 60 and living out another 20, 30 years even, in my opinion. Given that you can invest that $3 million and still get a return in your super, it can be in shares, bonds, it can be in property. So that's the purpose of superannuation. What's been happening is the superannuation system has been abused. And that's why they're bringing in these laws. The wealthy are not going to be happy about it. The very wealthy farmers, the very wealthy lawyers, doctors, the business owners that have 10, 20, 50, $100 million are going to be upset because now I have to pay 47 cents in the dollar to be better off than paying these unrealised capital gains tax. But I think that's why they're putting this cap on superannuation. I might be giving a different opinion here in this YouTube space. And I'm someone that I would consider myself very wealthy. We are very well off personally. So I think it's very reasonable for the government to want to set limits in superannuation to $3 million. Because if you've got over $3 million in your superannuation balance, then you're obviously very well off. And that's why the government's trying to tax accounts with a value greater than $3 million. Now, the big difficulty here is going to be the liquidity issue. So if you've got one property, it's worth $5 million, how do you sell a share or a value in that property? Because you have a name on the title, which in most self-managed super funds would be a corporate trustee with the Bear Trust, and then you've got the superannuation managed through that. How are you going to sell a portion of that if its valuation, its book value is $5 million, but you don't have any liquidity? What I've heard so far is that people can pay it out of their personal income. So if they have other assets, if they've got shares, then they can use their personal funds to pay the bill in the superannuation fund. Superannuation was brought in from the 1st of July 1992. So we've had the superannuation scheme for about 32 years. And I don't think this reform is the end of the world. They do need to iron out the liquidity issues. But yes, they are taxing the rich. That's what's happening here. But I think the superannuation system has been abused the last 20 years, with people pushing more funds into their super because of the tax incentives. And now they're trying to balance that out by bringing in this unrealized capital gains tax. It's all going to be about the execution as to whether it's effective or not. Now, we currently live in a realized capital gains tax system, which means you need to sell assets before you pay CGT, capital gains tax. The reason is that the current tax regime in Australia only taxes capital gains when they are realised, that is, sold, for more than the cost base. But under this new tax, a return is defined as any increase in the super fund's balances from the start to the end of each financial year. As most of the gains from shares and real estate are from inflation, fund members will pay tax every year due to simply rising prices. Well, you could say my property increases because of inflation, because of money printing. That's the way the system works. Governments create inflation by printing money, that's right, and a deficit spending. And now a tax on assets and super will arise from the resultant price inflation. Inflation is already a tax on the purchasing power of money, but paying this tax will further erode purchasing power. For assets with publicly available prices, so shares, bonds, stocks, things like that, the unrealized gains will be easier to track each tax year. The ATO has kindly offered to do this. Well, that makes sense, of course. If it's easy to track, they can go on the ASX and look up the prices, then yeah, that's fine. But for unlisted assets like direct real estate, private assets and collectibles, valuations will depend on the frequency, the basis and the valuer involved. So it's going to come down to the valuers for those illiquid and assets that don't have a trade market price to come up with a valuation each year for these superannuation funds. Where an unlisted asset like a property is the main asset, a member may need to sell the asset if they can't come up with the cash from other sources to pay the tax every year. So the new tax punishes investments that rely on capital gains. As most of the gains from long-term investment assets come from long-term value gains, which they say is simply inflation, I would disagree. Everything goes up in value, not just because of inflation, but because of demand. Demand and inflation drive up prices. Rather than cash flows, i.e. rent and dividends, which you'd still need to pay your marginal tax rates for rent and dividends if it's being distributed to you through your personal name. This new super tax amounts to a heavy tax on long-term investment, but savings is the source of capital for investment, which creates jobs, funds innovation, which is the source of increased productivity and living standards for the whole nation. It's a little bit biased, but yes, we live in a capitalistic society, therefore capital improvements and people owning capital assets contribute to that system. Now this is going to be lower from the 30th of June 2025. So it is coming into effect. And for most people who have over those $3 million balances, it means rejigging the portfolio with your accountant to bring things into your personal name or to have funds set aside for the inevitable tax. I actually don't think this is a bad thing as far as the tax system goes at a high level. I think it's actually good that we limit superannuation balances and then people pay through their marginal tax rates. That's the way it should be. I think we should all be on the marginal tax rate system. Businesses get the benefit of paying slightly lower tax rates, 25 to 30%, and marginal tax rates can be up to that 47 cents in the dollar. Obviously, that means businesses are incentivized to have retained earnings, to grow the business, to stimulate jobs and stimulate the economy. Whereas a lot of these superannuation assets are just stocks or property that's of a high value that if people are pushed into their super to try and maximize the tax benefits. And now what the government doing is doing a clawback. Now it'll be really interesting to see if this moves over to the United States in some form, because they're going to have an upheaval of the wealthy who don't want to pay unrealized capital gains tax depending on how they implement it over in the States. But I'd love to hear from you in the comments below. Do you have a superannuation balance over $3 million? And is that going to affect you? My superannuation is definitely not anywhere near $3 million, but I think it's enough for most Australians to live out their retirement comfortably. And any other assets or money you should have could be in your personal names or in company and trust structures, controlled separately if you're a very high net worth individual. So I'd love to hear from you in the comments below. What do you think of the unrealized capital gains tax? Is it a good thing? Is it a bad thing? Are you indifferent? Leave a comment down below. And if you're interested in seeing more videos from myself, YouTube thinks you'll really like this one. So click that video over here. Thanks for sticking around. I'll see you in the next one.